Morning, guys. It's Monday, September 22nd, 5:24 a.m. Central Time. Grain markets are mixed this morning. December corn futures up a quarter cent at 4.24 and a quarter. November soybeans down 5 and a quarter at 10.20. December Chicago wheat down 3 cents at 5.19 and a half. December Kansas City wheat down 1 3/4 at 5.05 and a half. December spring wheat down a half cent at 5.67. We've got some news out of Washington to start off this morning.
So, following a 2-hour phone call on Friday, President Trump and Xi Jinping agreed to meet in South Korea on October 31st to continue trade negotiations. Trump described the call as productive and said progress had been made on key issues such as trade, fentanyl, and TikTok. Trump plans to visit China early next year, with Xi expected to visit the U.S. at a later date. China has yet to purchase any U.S. soybeans for delivery in the current marketing year.
This was seen as being very disappointing for any soybean bulls out there. And I don't know how many there are, but if you were looking for some higher soybean prices or you were looking for some positive trade discussion with regard to soybeans or agriculture or just a broader trade deal in general, this phone call was very disappointing to you. The soybean market fell on Friday after this phone call and after Trump's Truth Social post, in which he basically told us what happened. There wasn't any discussion about ag trade. And as a matter of fact, the earliest we're going to talk about it now is late October, and it may actually be next year. So the November soybean contract fell below what I believe is some key support in that 10.21 neighborhood. If you're friendly to the bean market, you like to see a close above that today. But this absolutely helped to result in selling pressure in the bean market, also in the corn market and in the wheat market. Everything kind of backed off once the details of this call became public. So no positive trade news to start the week as we had maybe hoped for. And that kind of seems to be the deal here. They just keep kicking the can down the road on this thing.
The Trump administration is considering using tariff revenue to fund a bailout for U.S. farmers. USDA Secretary Brooke Rollins said the administration could announce an aid package soon as farmers struggle with declining exports and rising input costs. Before additional aid, direct government payments this year are slated to reach a 5-year high at nearly $41 billion. The new bailout could be based on the $23 billion aid program Trump rolled out during the 2019 trade war with China.
There is going to be a farmer bailout, I believe. I think there's like a 99% chance, especially following this Trump phone call where they're going to kick the can down the road on trade for another couple months. It's reasonable to say that a bailout will be funded by the tariffs. It's estimated that U.S. tariff revenue this year will be $300 billion, up from $83 billion last year. And a lot of this has already been collected through the month of August. U.S. tariff revenue was $165 billion in total. So there's plenty of tariff revenue to cover the farmer bailout. Now, that being said, the country is broke. How high is the debt, mama? $37.5 trillion and rising. You can't, I don't know that the USDA or Rollins or Trump can come here and claim any sort of fiscal responsibility. They tried to do Doge. Remember, they were going to cut spending and it just fell apart.
Mm-hmm.
You don't hear about that anymore because they can't. We can't stop spending. That's the problem with the U.S. government. And it's not this administration or the other administration. It's the entire U.S. government. We just can't stop spending. So you can make the argument that, the bailout's going to be funded by this or that, whatever. We don't have any money. They're just going to, they just create the money.
Right. Also on Friday, Trump announced a new $100,000 annual fee for H-1B visas, a sharp increase for the current cost of roughly $5,250. The administration claims the measure will curb abuse of the program and encourage companies to hire American workers. Critics, however, warn that the steep increase could price out smaller companies and undermine U.S. competitiveness, particularly in AI. The administration also announced its new Gold Card residency program, and it will cost $1 million for individuals or $2 million for businesses to sponsor an individual. According to Trump, the programs will generate hundreds of billions of dollars to help reduce taxes and the national debt.
We have a lot of viewers, I'm sure, that have H-1B employees on their farms, and those current employees are not going to be affected by this. This is only if you're applying for a visa now. It was after September 21st. In any case, the theory here is that Trump is going to protect American workers and wages, and that this H-1B program has had some exploitation and it results in artificially low labor costs. And I can get behind that in theory, because, we want to support American jobs, American first, whatever. But those of you guys in rural America know that it's very, very difficult to find any labor at all, much less skilled labor. So I understand, I think, both sides of this. I don't really have a strong opinion on it, but I think I understand both sides. If you guys have thoughts on this, drop us something in the YouTube comments.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
Probably the theme of Macro Friday with Jim, and we've been doing Macro Friday with Jim for at least 2 years now, is that the U.S. dollar continues to lose buying power. And the U.S. dollar, according to some statistics, has already lost 10% of its buying power just this year, 9 months or 10 months into 2025. And Jim and I talk about this. We talk about how to protect yourselves from this. We've done a lot of videos about this topic in the past. We covered interest rates. We covered unemployment, the economy, a whole bunch of stuff. I did corn and soybean marketing review on Thursday last week, ran through my spreadsheet. Here's the sales that I've advised. Here's what I haven't advised. Here's what I did right. Here's what I did wrong. These are the roadblocks and obstacles. This is the plan moving forward. If you guys are looking for a simple and transparent and well-explained approach to grain marketing, this is something you should check out. The premium deal is $50 a month. This is a content-only subscription. We have a new premium video out every single business day. Pete Meyer is going to join me today to talk about everything from what's going on with the trade war to crop prospects to USDA, all of that stuff. $50 a month, cancel at any time, no other fee, no other obligation. Nobody tried to say anything else. Support independent media, guys. We don't have any backing or corporate sponsors or anything. Everything that we do on YouTube and on the podcast is brought to you by the premium subscribers who float the boat for us. So premium subs, we love you. If you're not a premium sub, give that deal a shot this morning.
S&P Global projects U.S. corn acres will decline 4.3% next year to 94.5 million. In contrast, soybean acres are forecast to rise 3.6% to 84 million. Farmers planted more corn than soybeans this year due to corn looking more profitable on paper and offering some protection against Trump's tariffs. However, renewed optimism over trade negotiations with China has led the firm to project higher soybean acreage next year. S&P Global also expects all wheat acres to total 44.6 million, a 1.8% decrease from this year.
When you say corn looks more profitable, or it did this last year, it means it actually looked less loss-ish. Right. That's the way that it was on the balance sheets. Here is a ratio chart for 2026, and it absolutely favors the idea that we'll plant more corn acres than soybeans. And the budgets, so we did a budget video with Chris on Monday last week, I think. Based on early customer data from AgView Solutions, Chris had 2026 corn production cost at 461, and the board's at about 460 today. And that's a cash price, but you're close-ish to break even. You get one little pop in these 26 corn, you could be looking at a break even scenario for most farmers. Soybeans, on the other hand, Chris has his production estimate, again, just an aggregate of his customer base, early data, 1166 a bushel, and that's $1 above the Nov 26 board price, which is about 1066 this morning. So based on this, and based on the budgets, I think you stick with an elevated corn acre situation. Is it 99 million again? Maybe not, but I think it's probably still a number that's just too high.
China imported a record amount of soybeans in August. The nation's imports of Brazilian beans increased 2.4% year over year to 10.5 million metric tons, accounting for 85% of the country's total monthly imports. From January through August, China imported 52.7 million metric tons of Brazilian beans, down 2% from a year earlier, while imports from the U.S. totaled 16.8 million metric tons, up 31% year over year. A delayed Brazilian harvest and prolonged customs clearance earlier in the year fueled the surge in U.S. imports. According to Patria Agronegocios, Brazilian farmers have planted 0.7% of this season's soybean crop.
Traders seem to believe that China has its soybean import needs covered through most of October, but that they're largely uncovered into November, December, and possibly January. And then the Brazilian crop will be online. So this window in which China typically buys soybeans from the United States, it's understood that China doesn't have very much coverage. China uses 11 million metric tons of beans per month, and they use about, in total, two months of their needs are typically covered by the United States. So I guess one of two things is going to happen. Either they're going to be able to buy, call it 20 million metric tons of beans, 22 million from Brazil for Nov and December. And if they can't, they're going to risk drawing down their stocks substantially, which they don't like to do. So you could still make an argument that China needs some beans from the US. I just don't know if it's going to work out that way. I guess time will tell.
The funds trimmed their net short position in the corn market last week. For the week ending Tuesday, September 16th, large money managers were net buyers of 18,000 corn contracts. The net short position of 81,000 contracts is the smallest since mid-May. The funds were also net buyers of 14,000 soybean contracts and 7,000 SRW wheat contracts on the week.
The traders estimate that there was a lot of selling on Friday, especially in the soybean market. Maybe they sold 15,000 contracts, but I don't know. I don't see anything that's overly exciting here. The thing that's probably most interesting to me is that large speculators are basically flat the soybean market in net when the sentiment, especially as it relates to the trade war and the headlines, are very, very negative.
USDA reported a flash sale of corn on Friday. U.S. exporters sold 8 million bushels of corn to unknown destinations for delivery during the 25-26 marketing year. Accumulated net corn sales for the current marketing year are up an impressive 68% compared to the same period last year.
Yeah, I think we've got the second best export book on record for current marketing year. We're only 3 weeks into the year, but it looks pretty good. Brazil's become a little bit more competitive, but I think the U.S. still has the cheapest corn available on the export market.
We had a cattle on feed report come out on Friday. As of September 1st, cattle on feed totaled 11.1 million head, which was 99% of year-ago levels and steady with pre-report expectations. August placements came in slightly lower than expected at 1.8 million head, 1% below expectations and 10% below last year's levels. August marketings were reported at 1.6 million head, 14% lower than last year and roughly 1% below expectations. The report should be seen as another bullish factor, reflecting both the year-over-year decline in placements and the fact that placements fell slightly short of expectations.
So is this still supportive of these sky-high cattle prices?
I would say so. Yes, very much so.
We've seen some consolidation here the last few days in live cattle, like the December contract backed off and then we consolidated for a week. Same thing in feeder cattle. Still looks like a bull market to me, though. Outside markets this morning, the Dow Jones is off about 80 points. S&P is off a little bit. I think we had record high closes across the board in the stock market on Friday. Treasuries are up just a little bit. US dollars off a little bit. Crude oil down. Gold's up $53. Have a great week, guys. We'll be back on Tuesday.